makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Gita Gopinath in London. Francine Lacqua in Davos. Here's what's coming up on today's program. Christine Lagarde saying that the ECB likely to cut interest rates by summertime. The market's betting for aggressive easing, saying that they are a, quote, distraction. A similar message across the Atlantic from the Fed's Christopher Waller. He says there's no need to cut as fast as they have in the past. Meanwhile, right here in the UK, inflation picks up again, pushing BOE rate cuts further down the road. Plus, of course, coming up shortly from Davos, Francine Lacqua will be joined by the IMF's Deputy Managing Director, Gita Gopinath, as well as chief executives from Standard Chartered and Intesa Sanpaolo. Lots to digest there. We're going to bring you all of those live interviews shortly, but a quick check on these markets here because risk sentiment is souring around the world, specifically on both sides of the Atlantic. Right here in Europe, you are seeing the Stock 600 down by 1.2%, selling intensifying in the UK. FTSE down about 1.4% as well. Take a look at futures across the Atlantic, though. A very similar story. Now, some of this is coming from simply the conversation we've had around monetary policy. We're going to get to that in a moment, but the data you're getting out of China as well, that the property crisis is indeed getting worse there. But again, some would argue a lot of this is centered around the monetary policy story. In fact, as comments we got from a board of governor member of the Federal Reserve, Christopher Waller, just actually talking about whether or not it's the right time for these rate cuts. Take a listen to what he has to say.
With economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past.
And off the back of those comments, you did see a bond market move overnight that sent the 10-year yield right back above 4%, a 5 to 7 basis point move overnight. On the surface, it doesn't look like anything's happening, but I promise you it is, because you are having a repricing, a re-rating of basically cuts getting priced into this market. Remember, 6 to 7 cuts in the market price right now. But if you are starting to see the likes of Christopher Waller kind of pushing back against that, even though he is saying a rate cut may be due, you are going to see a yield that continues to climb. And that positioning story really matters. It's a similar story over in Europe as well, where you are seeing the German 10-year yield take that lead as well, higher by about 3 basis points this morning. What does that then mean for the currency story? Because dollar strength has been kind of a hallmark of what we have seen all morning. Euro dollar at 108 now, 126 on cable. Some really interesting dislocations there as we talk about the differences between what each central bank is going to really do in terms of tackling the inflation, or whether it's time to pivot a little bit, which brings me to a little bit of a zoom in on the ECB in particular. President Christine Lagarde saying that optimistic rate cut bets are not helping the central bank's inflation fight. Appearing at Bloomberg House in Davos, Lagarde also asked whether the ECB will start cutting rates by summertime. Take a listen to what she had to say.
I would say it's likely too, but I have to be reserved because we are also saying that we are data dependent and that there is still a level of uncertainty and some indicators that are not anchored at the level where we would like to see them.
That was ECB President Christine Lagarde speaking to our very own Francine Lacqua at the World Economic Forum. Those comments coming just a day before the start of the so-called quiet period that precedes ECB monetary policy meetings. Lagarde and many of her colleagues seeking to dampen expectations of that imminent loosening. For more on this, I'm joined now by Bloomberg's Jana Randau. Jana, interesting time frame. You never hear a leader of a central bank give such specifics. So is a cut by summertime a done deal then?
I wouldn't say a done deal, but it's become a distinct possibility. So I would say it's become quite likely. Of course, we've seen a concerted pushback over the past couple of days by governing council members, really from all spectrums, from doves to hawks, a pushback against those market bets that see the ECB starting to ease as early as April and by as many as 6 times this year. So that for pretty much every policymaker was too aggressive. So we've really seen them coalescing around that summer point of time. And of course, the ECB president, Madame Lagarde, embracing those comments and saying she believes it's a likely scenario for the ECB to cut rates in the summer That is as clear as it gets at this point in time, while they also stress they're data dependent. They're watching a whole raft of developments that may still derail that. But given or considering that the ECB keeps insisting it's data dependent, it's not in the business of offering forward guidance. I mean, the ECB president coming out saying an ECB cut in the summer is likely. That is pretty strong wording, especially 1 week, as you said, before the next upcoming ECB meeting.
How does that get reflected in the markets, though, at this point? Because on the surface, it feels like you see these small yield moves higher. They're kind of ticking higher despite the market largely positioned for some sort of big bet on the global bond market. Where do they fall in some of this rhetoric?
Yeah, I mean, what policymakers always say is that they're watching markets, and of course they're really, really important because ultimately, if markets price too easy a policy stance, then that is an upside risk for inflation, and that is clearly what the ECB doesn't want to see. But they say maybe the market has a different outlook on how inflation, how the economy will develop. It's their right, and ultimately data will prove who has the upper hand in that analysis. What the president said today. Or what she's watching very carefully is, of course, wage developments. In the first quarter, in the second quarter even, profit margins, energy prices, renewed supply chain disruptions off the back of the Red Sea tensions we're seeing currently. So nothing is a done deal. There's a lot of uncertainty still out there, and you may well have different views on how all those risks fall into place. So a lot can still go wrong. We will have to see, and in that sense, next week is going to be a very interesting next step when the Governing Council comes together, discusses the analysis, the data, does its analysis, and then the President will maybe have even more details to offer on where she sees the economy going, where she sees risks developing, and how monetary policy will develop this year.
Bloomberg's Jana Randau. We have to leave it there, but a really fascinating time to be covering this. We thank you so much for your reporting and your analysis. At the core of what she's talking about is not just the recessionary story, but the global growth story. How much momentum is there, and how much is the U.S. and the EU outlooks influenced by the likes of, for example, China, emerging markets, commodities, all of those questions to be asked shortly. We are live in Davos coming up, joined by Gita Gopinath, the Deputy Managing Director for the IMF. That interview coming up next. Stick with us. This is Bloomberg.
Welcome back to the World Economic Forum, everyone. We're here in Davos, day 3, and I'm Francine Lacqua. Now, markets appear to be growing more confident that the global economy can broadly pull off a soft landing. However, leading officials, including the heads of the IMF and the ECB, have warned against expectations for rapid interest rate cuts. Now, I'm joined by Gita Gopinath, the Deputy Managing Director of the IMF. Gita, thank you for joining us, braving the cold to give us predictions on the world economy. You've warned many times of fragmentation. Are we at the cusp, or could we actually have better news for 2024?
I think 2024 is a year where we're going to be more worried about the politics than about the economics. Geopolitical tensions are on the rise. We are seeing signs of fragmentation. If you look at global trade, if you look at foreign direct investment, it's there. It's in the data. And though we're here at Davos and we're talking about rebuilding trust, I'm a little worried that we're not in that environment where we can make that much progress in terms of building trust.
It also feels like because last year we were expecting a bad year economically, and actually we didn't get it, maybe there's a bit too much optimism given, as you say, the conflicts and also the potential for big oil swings.
The economics played out much better than expected. I think we've had a much more resilient global economy going into also 2024. The US, of course, did very strongly. The euro area, less well. But we've had upgrades for several of these countries, including China in the second half. Now, that said, I think we certainly should be jumping the gun and think that everything is done. When it comes to inflation, the job is not done. I think markets are being a little exuberant, expecting as many rate cuts as they've put in. I think it's important to be cautious. take the time, look at all the data that's coming in, and then move slowly. And that's consistent with what we're hearing from central bankers now.
And so, do you worry about a policy mistake if they cut too much and too quickly, or do you just see if you study the inflation numbers, we just can't cry victory yet?
It's a combination of both, because I do believe that with inflation, and if you look at services inflation, it is coming down, but it is still, not going down very fast. So I think we still have some stickiness in services inflation. Mm-hmm. Wage growth is still quite healthy in many countries. Now, on the other hand, of course, monetary transmission still has to work through the system, so there are still some downside risks. The problem is that if you cut rates, then that totally solidifies expectations of the direction of travel. And that is hard to unwind. And therefore, given where we are, given the relative resilience of the economy and of labor markets, it's important to take the time.
What's the biggest unknown? So apart from conflicts and geopolitics, and we'll maybe get onto that in a second, is it really how China, the economy will perform?
China's economy, the latest number that came out for the year as a whole exceeds the 5% target that they had set, so at 5.2%. I mean, that's, I guess, the good news. But on the other hand, there are some deeper issues in China. Of course, you have the aging demographics. You have a property sector that is still in a very tough spot. Local government finances are also in a tough spot. So if you look at our projection, for instance, for China going out, say, 4 to 5 years, we have growth at about 3.5%. So these headwinds play an important role in our projections. Now, that said, the Chinese government has stimulus ability. It can do the reforms to change the course, but there are important headwinds.
Gita, how difficult is it, again, to, it's impossible, actually, to predict elections, to predict policies. We have over 50% of world GDP citizens going to the polls. So where do you see the biggest shock coming from that world?
There are very many important elections happening all over the world, including in the biggest democracies in the US and in India. There's always a period of uncertainty before election results come out, and that has some effect on markets. And then, of course, we're going to see what the results are for global relations. Like I said, I think the politics is more trickier right now than the economics is. But of course, when you have geopolitical developments, that has impact on the economics. The conflict in the Middle East remains, at this point, it is still contained, though we've seen some escalation. Oil prices are below where they were before the conflict started in the Middle East. But if there is a regional escalation, then again, that compounds everybody's problems, including in the fight in bringing inflation down.
Are we underestimating the changes still to come on supply chains?
There is absolutely a risk. We're nowhere near what was during the pandemic in terms of supply chain disruptions. But what we're seeing in the Red Sea, could be an early sign. We should be careful. I don't think we're definitely not there yet. Yeah. But those are the kinds of supply chain disruptions that could make it very difficult for economies around the world.
And again, it's very difficult to speak about the world economy as something that's harmonious, because it really depends on country by country, some of the structural reforms. Are you optimistic on Europe? And what's your take on emerging markets? Again, it's very country by country. We know, for example, that the new Argentina president will meet with the IMF head.
So in Europe, of course, it's been a tough 2023. The last quarter, of course, is going to be tough. Now, going into 24, just given that they're coming from a low, we expect there to be a recovery in the euro area in terms of the economic growth prospects. The UK is more flat in terms of our projections. This is from October. We will have newer updates in the end of this month. Mm-hmm. In terms of emerging and developing economies, India doing better than we expected. Mm-hmm. China, actually, our forecast for 2023 was 5.4%. It's coming at 5.2%, so somewhat slightly lower than what we expected. But it is also true that if you look like markets like Brazil and Mexico, you are seeing resilience, including the labor markets. I have to tell you that the one very interesting fact is that if you look at labor force participation rates around the world, not just in advanced economies, but even in emerging developing economies, that has done better than expected. And we were worried during the pandemic that this would be, a scarring factor.
But how do you explain this? Is this a cost of living crisis phenomenon, so that if people feel that actually they maybe have, less money, then more people in the household go to work?
Well, this is also a reflection of the resilience. I mean, we've seen a lot of job postings, a lot of vacancies being posted. So that it is a relatively strong labor market in many countries.
I mean, how do you explain this resilience? I mean, we sometimes look at the numbers in the newsroom and think
Yes.
like, it is actually incredible, the amount of interest rate rises, the amount of shifts that we've seen, and still the global economy being okay.
I think it's a combination, of course, of the very substantial public support that was provided during the pandemic, during the energy crisis. Yeah. So we're looking at households with strong balance sheets, we're looking at companies with strong balance sheets. At the same time, we've got a lot of the cost of living coming off because of improvements in supply and supply chain disruptions without there needing to be tightening of the labor market. So it is, again, a resilient economy. But that said, I don't think we should underplay the fact that if you look ahead, our growth forecasts are around 3%. That medium-term growth is the lowest we've projected in a couple of decades. So the good news is we didn't have recessions, but we still have a problem to take care of, which is in general a weak growth environment going forward.
Because we could see this weak growth environment, I guess, stay for much longer, so kind of like stagnant.
We are,
right?
yes, so we have about, our projections 3 to 4 years out is about 3%. It used to be 3.8%. That number used to be around 3.8% for the last, for a couple of decades. So, and that's not just about one part of the world. We're seeing this uniformly the case in advanced economies and emerging and developing economies. So that's where, AI, and that's what's being discussed out here. The hope is that that could be one source of productivity increase.
But Gita, every year we talk about debt. Every year we say we have to watch out for levels of debt of the US and other, developed nations. Yeah. And then it just gets brushed off and more debt gets issued, it gets bought, and we're okay. Is this a real problem, and in what time frame?
Now, firstly, debt is at extremely high levels. That is an issue in many countries in the world. What worries me on top of that is that we have projected fiscal deficits that are going to be higher than they were pre-pandemic. I mean, the U.S. is an example where deficits are in the range of 7 to 8%, and we're expected to stay there for the next few years. Now, the U.S. doesn't have a sustainability problem, obviously. It's one of the safe asset producers. But when you put that much of U.S. bonds on the market, it can crowd out other kinds of funding around the world, and that has implications for the developing world. Compared to what we spoke about last time when we were concerned about solvency risks in low-income countries, I think this year we are more worried about liquidity problems because many countries borrowed a lot during the pandemic that was short-term in nature, and that's coming due. So I think liquidity risks are something we should pay attention to. And this would be overall, or is it, again, specific? It is concentrated. I mean, it's not a systemic issue.
Okay, Gita, as always, thank you so much for joining us today. That was Gita Gopinath, the IMF's first Deputy Managing Director. Now, coming up, JP Morgan's Daniel Pinto says the bank plans to increase headcount this year. Find out why next. This is Bloomberg. I'm Francine Lacqua, live from the World Economic Forum here in Davos. Now, the president of JP Morgan has told me the bank plans to add headcount this year. The Wall Street firm sees opportunities in international retail, U.S. wealth management, and investment banking.
We are employing, at the end of this year, around 320,000 people. So the number of people that we employ has been growing and not shrinking. So I think that where we see opportunities and we can help our clients, for sure, we will focus on that. When I look at our plans, we will increase our staff this year, for sure.
Now, Daniel Pinto says the profitability or the probability of a soft landing in the U.S. is increasing as time goes by. Elsewhere in the world, the bank's president also says that China and Europe are both struggling with their own set of unique economic challenges.
China has many challenges. Real estate is one. They have issues with their population aging and things like that. So though the stimulus to the economy is going to stabilize growth, probably for the first half of the year, in the medium term we see the Chinese economy slowing down in growth. And Europe is struggling. I think that high energy prices, the slowdown in China, people that they are concerned. Saving rates are going down in the United States because people believe in the economy and they feel confident to spend. In Europe, it's happening exactly the opposite because of the war and the economy not growing and all the challenges that they are facing. So there are issues. So those are important issues, and at the moment they are not improving.
But if you look at European equities, they're cheap. So is it actually a good time, again, if you bring it back to the markets, what does 2024 bring
I think that they are pricing the economic reality. To go from there to cheap, I think that it may be a bit too early.
Well, JP Morgan President Daniel Pinto speaking at the World Economic Forum in Davos. Now, also making news, BP has appointed Murray Auchincloss as its permanent chief executive, and this is 4 months after the shock resignation of his predecessor. Now, the decision ends really a period of uncertainty for the London-based oil major. Auchincloss was named interim chief executive in September after Bernard Looney resigned for failing to fully disclose past relationships with colleagues. Coming up, more from the World Economic Forum in Davos. The Intesa Sanpaolo chief executive, Carlo Messina, joins me next. That will be a good conversation on markets, on banking, and of course on Europe. Christine Lagarde tells us the ECB is likely to cut interest rates by summer, but markets bet for aggressive easing are a distraction.
I would say it's likely too, but I have to be reserved because we are also saying that we are data dependent and that there is still a level of uncertainty and some indicators that are not anchored at the level where we would like to see them.
In the UK, inflation picks up again, pushing BOE rate cuts further down the road. And back in Davos, yes, day 3, it feels like a week, but day 3, the JP Morgan president tells us the Wall Street Bank plans to add to its headcount this year amid a wealth and deal-making revival. Well, good morning, everyone, and welcome back to our special coverage right here in the freezing cold Davos. I'm Francine Lacqua. Now, S&P Global ratings say that profitability at Italian banks is set to be higher than for European peers. The outperformance comes after years of cost-cutting and balance sheet cleanups. Well, joining us now, I'm delighted to say, is the Intesa Sanpaolo Chief Executive Officer, Carlo Messina. Mr. Messina, thank you so much for giving us a little bit of your busy schedule. When you look at Italian banks, and actually when you look at your bank in particular, you have very high ambitions for profitability over the next 2 years, but we have a quite uncertain economy. So how do you match up the two?
I think that if you look at the fundamental of Italy, fundamentals are really strong. Family and companies today, in my view, are in better shape compared also to France and Germany. And the evidence is quality of credit that is really very good. And also attitude of families to be ready to enter again into wealth management products. So I think that we are in a unique conditions in Europe to have a very good performance during 2024 and then accelerating in 2025. And especially for us that are a wealth management company, this could be very positive.
Are you surprised at the resilience of the economy given what we've seen with interest rates?
Yes, that's one point. If you remember, before the starting of the COVID-19, all the investors were worried about Italy. At the end, Italy has resulted that the best country in Europe. If you compare growth with France and Germany, today, after COVID, we had the most important growth in Europe. And the strength of the families and companies, in my view, is really related to the very low indebtedness of families and companies. That's very important for the country.
But do you worry about the debt level of Italy again? And Italy, you know, maybe has done better than expected because other countries have also done worse. Like the dynamic is unclear at the moment.
Okay, that's probably a part of the story, but the comparison with the others is part of the story. Also, if you want to make benchmarking, is part of the story. But at the end, if you look at the real level of indebtedness of families and companies is unbelievable in comparison, very low in comparison with the other. The debt, the public debt is high, for sure, but it is sustainable. In Italy, we have 3 trillion of debt, but we have 12 trillion of wealth of Italian families. And at the end, in my view, the state has the property of 300, 400 billion euros of real estate assets, and the state is not the best owner of these assets. These assets can be placed through funds to the Italian families, to pension funds, institutional investors. So if the government can decide to make a significant project in order to reduce the debt, Italy, in my view, can be the best place in Europe.
So what does that mean for your growth plan for the bank? I know there's been speculation about acquisitions in the past. We now talk about possible cross-border. We're speaking to Deutsche Bank just a couple of days ago. Like, what happens to Intesa in 1-2 years from now?
Okay, so you know that today the environment interest rate is really in favor of the banking sector. Yeah. We are in a unique position because as soon as the interest rate will go down, and will happen after the summer, we will have again the lever of wealth management that will start to give us fee and commission. And we have already selected 100 billion euros of wealth of our clients that can be converted into wealth management products. So it's a massive amount that can be transformed in fee and commission. So for this year, we will deliver, in 2023, we will deliver an incredible high level of net income, well above 7.5 billion euros. But 2024 and 2025, we expect net income to grow again, also in comparison with 2023. And the most important lever will be fee and commission. So we remain concentrated in deliver this very high level of net income. So making acquisition is something that is very important, but at this level of profitability could be something that can be for the people working in the organization. You cannot be distracted by delivering this significant amount of net income and also this 100 billion of extra wealth management that we can generate in 2024.
So what does that mean? That you're looking at you have potential targets in mind in regions, but wait for valuations?
So you know, Francine, that we are really concentrated in wealth management area. So we are not interested in retail and corporate targets, and this means that the wealth management targets today are very limited and very expensive, so with significant goodwill embedded. That's the reason why 100 billion euros of extra wealth management that we can generate internally is more or less a medium-sized acquisition in a wealth management company in Europe. So for this period, I will be concentrated in deliver this. Then the aspiration, in any case, is that Intesa Sanpaolo can be a clear leader in Europe. We are a leader in market cap, but we want to be also a clear leader in Europe in the next years. But 2024 will be a year in which we will be concentrated on wealth management internally.
I mean, when you say in the next years, is it, I mean, does regulation need to change? Do we have to have a capital markets? In terms of what you would ask, of course, leaders and regulators?
So it is clear that the regulation at single state, it is not in favor of making cross-border deals. But there is also a matter of synergies in my understanding, because you cannot make a transaction only saying that you can generate revenue synergies, because it is blah blah for the investors. What you have to demonstrate that you can reduce the cost base. And the only way to reduce cost base is to have a real potential to reduce the cost base, administrative expenses, IT investments. So this could be an area. So the IT investments, the artificial intelligence technology can be an area that can become one of the key drivers for future cross-border deals. Today, probably the only way to have revenue synergies is to work on an internal potential like us for wealth management.
How do you look at AI and actually to transform? We've talked in the past about fintech, yes. And I know you have a digital also unit which we'll talk about for a probe. But in general, how does it change banking and how you speak to clients?
It is clear that this is a transformation that also in the banking sector we need to accelerate. In Intesa Sanpaolo, we have an investment of 5 billion euros in technology. And as you mentioned, we worked with Thought Machine and Google, and we created EasyTech and EasyBank. That is our technological on cloud, probably the best in class today in terms of technology. But this area of artificial intelligence we want to use for business, but mainly for control, for cybersecurity, for compliance, for risk management. And if I can add a point that is something that I consider really very important for the people working in an organization, is that we want to take care of the number of people working within the organization. So artificial intelligence could be something positive, but as a CEO, my duty is to maintain the workforce within the organization. And we are working in order to create new jobs, especially on the social activity, inclusion. We made a project of 1.5 billion euros of donation, and we had 1,000 people working in this out of 100,000 people working in the organization. And this is something that I consider very important for the organization.
Carlo, could you also update on the digital unit? So if you look at Italy's competition regulators, they're basically looking into some of the transfers were okay and transparent enough. Where are you on this?
So you know that each time that you create something that is an incredible innovation for a country, you have, because our Easy Bank is something that is probably the most important innovation in technology that was realized in Italy in the last years. There are some things that you have to adjust in the phasing of the preparation of all the different areas. In this Easy Bank, we increased the number of clients by 60,000 clients in a few months. We made some new clients in this entity. Now we are working in order to redefine the kind of communication with clients, because the authority wants us to have a more friendly approach, and we are ready to do this. But what it is important is that Italy needs to have improvement in technology. We created the best technology in Italy, and now we will make this as best in class.
So it's not affecting business?
No.
Okay, Carlo Messina, thank you so much, as always, for finding a little bit of time to come on Bloomberg TV. That was Carlo Messina, the Intesa Sanpaolo Chief Executive Officer. Now, still ahead from Davos, we'll also be speaking to Standard Chartered Chief Executive Bill Winters. That conversation is next. We'll also focus on China. This is Bloomberg. Welcome back, everyone. I'm Francine Lacqua, live from the World Economic Forum here in Davos. Now, Standard Chartered has added 2 additional Fed cuts to its 2024 outlook, anticipating a total of 4 25 basis point reductions, with easing beginning in May or June. Well, I'm joined by Standard Chartered Chief Executive Officer Bill Winters, and also welcome to our Bloomberg Radio audience tuning in now. This is exciting. You have radio listening, Bill.
I'm delighted. I look much better on radio.
Cross-platform. I feel like, cross-platform also for banking is really the way to go. What do you worry about the most in 2024?
Yeah, I mean, I must say 2024 is starting off from a banking perspective quite well. We know all the problems in the world, and we are always concerned how those are going to affect the operating results of our bank or others or our customers. So far, so good. I think the economy is in a reasonably good place. Of course, the tensions that are carrying over from last year are still there. Obviously, the war in the Middle East is a big preoccupation, and concerns that will spread, although it seems manageable so far from an economic perspective, yes. Obviously, perhaps not from a humanitarian perspective. And likewise, conflict in Europe, and likewise, the geopolitical tension. So, but these are, I won't say we're used to these things, but they've been around for a while. It would appear that no one has an interest in taking very substantial specific conflicts and turning them into major global operations. And I hope I'm not wrong on that.
Yeah, we were expecting, I guess, the economy to really suffer more than expected in 2023. Yeah. Does that skew markets thinking on how resilient 2024 is going to be? I
think there's a risk of some complacency building in, that because we haven't had a big interest rate related correction in economic activity so far, that we're out of the woods. But obviously the signs are encouraging. And I think there's no doubt that in order to complete the fight against inflation, we're going to have some slowing economic activity. And in particular, we're going to have a slightly less robust jobs market, in particular in the U.S. But it's very robust right now. But things are going in the right direction. Yep. When I look at China with their GDP figures yesterday, yep, in line with expectations, I think China's going through a very major transition in their economy, from old economy to new economy, and dealing with the aftermath of the geopolitical tensions and tariffs and restrictions and things of that nature. And China plus one, we know the story. And I think against that backdrop, China's actually doing quite well. The new economy sectors are booming. Yeah. And the old economy sectors are really struggling, led by property. Yeah. So I look at that whole equation and say, there's plenty to be optimistic about in 2024. Yeah.
But so what do you do with property in China? Again, it's unclear how, the authorities will deal with it, what kind of leeway they have or appetite they have for letting some steam out.
I mean, for us, it's a relatively small problem. We've taken some losses over the past 3 years. Our credit losses overall are very small. The bulk of them have come out of China. So it's not a huge preoccupation. I think the Chinese authorities have stabilized the property market, but it hasn't corrected, and it hasn't fully, the prices haven't cleared, right? The market hasn't cleared. So I think we'll see some ongoing support measures to just let the market equilibrate. But that's just one part of the old economy in China, the historic drivers of GDP growth that are in reverse, and some other elements of the really heavy manufacturing sectors. And some other more commoditized manufacturing are moving out, either through the China Plus One or cost competitiveness. And I think the result of that is China has to focus on growth in the areas where the growth opportunities are there for them. And they are. They are.
But so if you look at 2024 and beyond, what do you do with India, for example, from an economic perspective?
In India, we invest heavily. India it's a fabulous growth story for years to come. The economy is quite a bit smaller than China, but they're determined to catch up. And over a period of time, I think they can.
What time frame? Is it difficult to say?
The Chinese economy, GDP per capita in China is in India is 1/4 of China. So, a long way to go. But if China closed the gap to big chunks of the middle income world over a 20-year period, I think that's a reasonable aspiration for India as well. And they're well on that track. If they can consistently generate 7-8% growth, which they should be able to.
Talk to me about the Fed. So the market is definitely pricing in a lot of cuts.
Yeah.
From the Fed, I don't know what that means for your trading floor. Are they ready? We could see a lot of volatility.
We could. Although markets have been quite well behaved. I think the Fed has done a good job of forecasting and indicating for guidance their intentions. I think the market might be a little bit ahead of itself in terms of rate cuts this year. I have no doubt that we'll get to rate cuts at some point. I suspect it'll be a little bit later in the year. So we have this debate within Standard Chartered all the time. And we're positioned in terms of our from a treasury perspective, we're partially hedged, but we're okay sitting tight for a little bit on the rest. And
where do you think treasuries are headed?
We've seen a big correction in treasuries, right? With 10 years dropping almost 100 basis points. That's a big move down. If we think that the stable, long-term risk-free rate, the short-term rate, is going to be something like 2.5% or 3%, then Treasury should settle somewhere around where they are, somewhere around 4%, which I think is probably pretty healthy for the economy as well.
Yeah, when you look at trading, I don't know whether you're starting to now try and calculate what Trump in the White House means for policy, for markets, for trade.
It's very hard to know, right? And we know that the Davos had ballooned under Trump pre-COVID. Obviously, it ballooned during COVID, but that didn't balloon any less under the Biden administration. So where we go from here, I mean, there's very little sign of fiscal discipline from either party right now. Which is, I think, concerning. But reality finds ways of biting.
What does that mean? Like a treasury auction that doesn't work? I mean, could it be really ugly?
It could be. I think it's much more likely that you just get a little bit of a buyer's boycott, and you see treasury yields that are not behaving consistent with the way the Fed would like short-term rates to play out. And a failed auction would certainly be a message, but I think that would most likely be...
Is that possible in the short term?
It is, but I think it's much more likely to be attributed to technical features of the Treasury market. And of course, I mean, you've spoken with a number of my counterparts at the U.S. banks who are very concerned about the capital rules that are coming in place and the degree to which it hits the trading books, which would have the effect of withdrawing capital from that market, which is already pretty stressed. So I think it's much more likely to be a technical thing than a fiscal thing.
I mean, are we so sure? We talk so much about what Trump in the White House means. Do we know, or do you understand, like what policies a second-time Biden administration puts in place?
Well, I would think a second-time Biden administration would find some fiscal rectitude. Okay. I think they inherited an economy that was coming out of COVID and made sure that things the pump stayed prime, as it were. And we had a significant cost of living crisis at the time for all the reasons we understand. So I think that the Biden administration, led by the Secretary of the Treasury on the economy side and the Fed, are very orthodox. And no country can run the kind of budget deficits that the U.S. is indefinitely. So, and I think they're very orthodox, and I think they would take a conventionally orthodox approach. Probably not going to hear much about that before the election. But that's politics.
Bill, HSBC also has Zing, which is basically trying to rival Revolut and Wise. I mean, do some of the big banks really have a chance of going after these fintech companies?
Oh, I mean, absolutely. We've set up a dozen digital banks around the world now. We've got cross-border payment platforms. We are, dare I say it, there's really nothing that you could do on Revolut or Wise that you can't do on a Standard Chartered or many other bank mobile apps.
So why are we not?
We are. We are. I mean, our business, I think last year we completed 82% of our transactions were straight through, no human contact. I don't know if it's the highest in the banking industry, but it's a very high percentage. We may be the only bank that actually discloses that figure, so it's a little bit hard to know. But no, we've learned from these guys. I mean, when we set up our digital bank in Hong Kong 4 years ago, we looked at the best in class of digital banks around the world, including...
Which is? Who's best in class?
Well, we looked at people like N26, and Revolut is very good. We looked at the digital offerings in existing banks. We benchmarked ourselves against those, and we came up with something that we think is best in class. We're so happy with it that we rolled out the same tech stack in Singapore. We gotten almost 15% of the bankable population in Singapore has opened an account with our digital bank in Singapore. It's called Trust Bank. It's the fastest growing digital bank in the world. Now, it's Singapore. It's obviously if we could do the same thing in China or in India, we'd really be in the money.
And the UK?
Or the US. No, the UK, I think, is pretty thoroughly banked. And starting with the banks that you mentioned, banks like Monzo, which are excellent, in addition to excellent local banks. And we don't have a retail presence in the UK. But we do have a banking license. We do have a banking license.
Which others don't. Bill, thank you so much. Bill Winters,
thank you.
Chief Executive of Standard Chartered. Now, we'll have plenty more, of course, from Davos coming up. Sam Altman, the Chief Executive of OpenAI, also speaks to Bloomberg about the global implications of artificial intelligence. We'll bring you more from that conversation right here in Davos next. This is Bloomberg.
It's not yet like replacing jobs in the way, or to the degree that people thought it was going to. Of course, jobs will change, and of course, some jobs will totally go away. But I think AGI will get developed in the reasonably close-ish future, and it'll change the world much less than we all think. It'll change jobs much less than we all think.
Well, that was Sam Altman, the OpenAI Chief Executive, speaking at Bloomberg House here in Davos. Now, Bill Gates was also at Bloomberg House, a co-founder of Microsoft, told us AI is the biggest productivity advance in our lifetime.
AI is a brilliant tool for people to be more productive. Now, it means the bad guys will be more productive, so they can do more cyber attacks, so they can design weapons. You've got to make sure the best AI for cyber defense or measures to defend against bioterrorism are in the hand of the good guys. And it's a challenge, but people sometimes lose sight of the fact that this is the biggest productivity advance in our lifetimes.
Well, that was Bill Gates speaking to me yesterday at Bloomberg House in Davos. Now, just ahead, we'll be speaking to the president of the Swiss National Bank, Thomas Jordan, and then we'll be also speaking to the Spanish Prime Minister, Pedro Sanchez. We'll continue, of course, the conversations on inflation, global growth, and some of the challenges that AI could pose coming up. This is Bloomberg Live from Davos, Day 3.